Today at InvestTalk, we discuss what younger generations can learn from poor planning by current retirees. Then we look at why the Mag 7 stocks lagged in a very bullish tape today. I also answer questions about Whirlpool, Dave & Buster's, Colgate-Palmolive, and more. And at the end, I give a preview of the holiday shopping season.
This is InvestTalk, independent thinking, shared success.
Now, my main focus point today concerns the retirement crisis, and many older Americans lack financial security for a couple of reasons: poor financial literacy and lack of foresight. And according to AARP, 1 in 7 retirees depend on Social Security for 90% or more of their income. Now, Social Security was not designed for that. It wasn't designed as a sole source of income in retirement. It was more supplementary, right? In addition to a pension, for example, or a 401k. So a defined benefit or defined contribution plan. And this is leaving many retirees either in poverty or on the brink of poverty. And really, once again, this is lack of foresight and financial literacy, means inadequate savings during their working years. And, the inability to work anymore kind of creeps up on people. And health problems kind of creep up on people. And then eventually they say, oh, I can't work anymore, or I can't do what I used to do. And now my income's dropping or being eliminated, and I don't have enough money because I thought I was going to be able to work longer. So we can learn from this crisis, okay? But we have to do a few things. And it starts both on the macro level, government on down, and then on the personal level as well. Now, on the government level, you have to examine kind of consumer behaviors, explore new policies, and implement incentives to encourage people to effectively save. Now, more schools are implementing financial literacy programs, but more work needs to be done. A study by the CFA Institute found that 23% of Gen Z investors have no formal financial education. And many Americans are still unaware of basic concepts like compound interest, how to choose the right retirement account, etc. And so both schools, employers, government agencies, they all have to play a role here. Now, one promising approach is automatic enrollment. And I know there are some rules here in California like this, and I think in many other states, that are making employees have a retirement plan and automatically enrolling new employees in it. But that's probably not enough, especially for low and middle income workers. Those are the ones that have the most time just saving. So there's something called the Savers Credit, and this helps low and middle income Americans who contribute to a retirement plan by cutting up to $1,000 off their tax bill when they file their annual income tax. So instead of a writing it off on their income, it's an entire tax credit. Okay, for $1,000, $2,000 for married couples, but you have to be, once again, low and middle income people. What about making the entire amount that you put into an IRA a credit versus just a write-off? That's one thing that could change. Now, another layer here is that the type of work is evolving, especially for those low and middle income consumers, and that has to do with the gig economy, right? Uber and DoorDash and et cetera, they're not offering retirement plans. And so the people that are working those jobs, they're not really realizing that they're missing out on a big part of traditional compensation packages at companies. It's not just the salary, but it's health insurance, it's retirement accounts, matching 401k contributions, etc. And so finding ways to improve those people's savings mechanisms will definitely help. Now, younger Americans have grown up hearing Social Security may not be available in its current form when they retire. And that's encouraged them to save earlier. But even with that, they're not saving enough, mainly because of student loans. They don't have the disposable income after paying for life plus student loans to really continue to save. So that's kind of on a macro level, but what can you do on an individual level? Now, the first is, and I see this all the time, do your very best to wait until full retirement age until you take Social Security. It rarely makes sense to take Social Security before your full retirement age, okay? Rarely. Now, everyone's situation is different, so I don't want to say never, but it rarely, and I see this all the time. We had a new client coming on board, and his wife was badgering him to take Social Security. They were 64. And I said, unfortunately, they didn't consult with me before. It's something we do for clients is figure out when they should take Social Security. Is it full retirement age? Is it at 70 or is it earlier? This is part of, having a financial advisor. And so unfortunately, he turned to me a little late. But it was one of those things where somebody who, they just feel like they need the money, but it's you have to make that decision in the full context of your financial plan. So that's number one. Number two is maximizing contributions to your IRAs, your 401ks. Take advantage of catch-up contributions. Then consider working beyond your traditional retirement age, beyond 65, if you can, even if it's part-time. It's not only good for your pocketbook, but often it's very good for your mental health and longevity as well. And then, once again, sit down with an advisor, figure out your healthcare costs, your housing needs, your long-term care expenses, etc. It's something we do for clients. And you need to make sure you are focusing on those things as well in order to avoid the pitfalls that many current retirees have already made. Explore additional content and tools by heading over to InvestTalk.com. Now let's take a quick look at the market today. It was quite the positive day overall. And what was interesting here was the growth side of the market did well, but not the big names, not the mega caps, not your Mag 7 names. Google was down 5% on more antitrust worries that they're going to force them to spin off their Chrome browser and really break up Google in some way, shape, or form. Now, obviously, this is kind of a last-ditch effort by the current Biden administration. We'll see if it gets taken up by the Trump administration. So that will be interesting. But you had other names down as well. Amazon down over 2%, Microsoft down about 0.5% there, Tesla down as well. You did have Meta only down about 0.5% there, Apple down slightly. NVIDIA was up on those earnings, but only 0.5% there. But if you look at the rest of the market, it did very well. You had names like IBM up about 3.5%, Intuit up about 4.3%, Costco was up nearly 3% there, Applied Materials up 3%. I'm just listing off a bunch of these names. If I'm looking at the heat map, pretty much every sector of the market did well outside of those mega Mag 7 names. So that was very interesting. The bigger the company, the kind of worse it did today. And that's a very interesting new dynamic that we're seeing in markets right now. The NASDAQ was basically flat on the day, only up 6 points there. So not a whole lot of movement. The Dow was up over 1%. The S&P up over 0.5%. So the quality names did very well. You had names like Snowflake was up 32%. Oklo, that's in the uranium sphere, the small modular reactor space, that was up 20%. So some big movers on that front. Teladoc was up about 15%. MicroStrategy, that was down 16%. You had some China names like PDD down 10%. And certainly a mixed bag overall, but generally positive outside of those Mag 7 names. So pretty interesting start to this week so far after OPEX last week. And overall, you just have to be generally bullish on the markets, but probably not those mega cap names.
Just calling to check about Dave & Buster's. The ticker symbol is PLAY. Just want to get your thoughts on it. The price has dropped, pretty dramatically, and want to see if this is a sort of business that's sustainable during this financial environment. Can't wait to hear. Thank you.
All right, looking at Dave & Buster's, PLAY is the symbol. And this is the name that is down substantially since its high in April, around $70 per share. Now we're down to $34 per share. Still off the 29 and change for the 52-week low, but certainly the technicals are weak. And the big issue here is the debt. And we've talked about this before, that you don't want companies with a lot of debt on their balance sheet. So they have negative free cash flow. Their times interest earned is only 2 times. That's too low. And then they still have about $1 billion, $1.3 billion, in long-term debt on their balance sheet. And that is not a sustainable situation, frankly, when you have negative free cash flow. And the long-term debt in 2022 went from $431 million all the way to $1.3 billion. And in a rising interest rate environment, that becomes a problem. And that's why earnings are expected to fall 27% this year. And once again, free cash flow is negative. So you don't like to see a levered company with negative free cash flow. And, we're in a world where there's a lot of other entertainment options. And I just don't think that this is a great way to invest, or great place to invest. So I'm going to pass on Dave & Buster's, PLAY. Now, we've been telling your friends and family about our free podcast downloads, which you can find available in video form over on our YouTube channel as well. And we get questions in the comments section, and let's tackle one of those now. CJM says, "Hi, InvestTalk. What are your thoughts on Heico? I own it and want to buy it. What's a good entry point?" Again, HEI is the symbol here. So let me pull this up. HEI, there we go. Now, this is in the aerospace defense, and it manufactures jet engines, aircraft components, replacement parts, electronic and electro-optical systems. $38 billion market cap. And this is an interesting one because it's really done well since the election. And the idea is that those in Europe are going to see some funding pulled. And they're going to have to invest in their own defense. And the demand for aerospace and defense supplies will get a new major buyer. And I have some sympathy for that. But I think the broader question is, will current hostilities, I won't say come to an end, but will they be tamped down? And will the surge in earnings over the past couple of years, because they made $211 in 2021, $242 in 2022, $286 last year, so let's make $3.65 this year. And revenues are just going gangbusters, up 37% last quarter. Earnings were up 31%. So, and this is trading at a very high multiple. So I would not be buying it at these levels. It's just too expensive for me. And I don't necessarily think that this is a trend that will remain durable, because we're still the biggest buyer, biggest spender when it comes to military equipment. And obviously our fiscal situation is a bit dire. And I don't think this is a name that I would want to pay extreme multiples for. So, and this recent move up actually is not being confirmed by the MACD. So I'm seeing some technical divergence here and high multiples. And so I would pass on Heico. Now let's play another caller question now.
Hi, Sheila from New York. I have a question about Entergy Corporation, ticker symbol ETR. What would be a good entry point? Thank you. Bye-bye.
All right. Looking at Entergy. Just pull this up. My mouse wants to cooperate here. Okay. Entergy, engaged in electric powered production and distribution to 3 million customers in Arkansas, Louisiana, and Mississippi. This has been booming. Earnings are supposed to go up nicely, 7% this year, 7% next year. But I think it's kind of ahead of itself. It's trading at a forward-looking mid-20s multiple. I think that's a bit extreme here. And I think you're trying to play the momentum, and I think you missed the momentum. Okay. If I pull back to a daily chart, This went up on, looks like wasn't the election. Actually, it was obviously on earnings, because this was on Halloween on October 31st. And it's been consolidating since, but it's not really holding it that well. And I think the momentum is waning here. Revenues were down 6% last quarter. Earnings were down 9%. Now, earnings are supposed to accelerate into next year, but I'm not going to pay this much for a utility that just really isn't that exciting from an earnings perspective. So I think you're barking up the wrong tree. I think you're just trying to chase that momentum. And I think there's better opportunities in the same space. Yeah, they are the second largest nuclear owner in the U.S. I like that, but I just don't see the multiple. I don't see the valuation here being attractive. So I'm passing on Entergy. Thanks for the call.
Hello, this is David from San Luis Obispo. My question is about natural gas. Natural gas seems to be nearing its historical lows. So does an investment in UNG directly make sense? Thank you.
Are looking at natural gas, and I am a bit bullish this winter on natural gas. One chart I saw was the average temperature in Antarctica, and it was below the long-term average, well below, which portends to likely a colder winter. And a colder winter means more people are cranking those heaters and burning more natural gas, and that tends to be bullish for natural gas. So I like what you are thinking. I do think natural gas in the short to medium term is likely headed higher. But make no mistake about it. You do not want to buy UNG for this, okay? And just go look at a longer term chart of UNG. UNG is the United States Natural Gas Fund, and they're using futures to bet on natural gas. The problem is when they roll those futures, there's costs there. And that's why if you go back to 2007 when this came out, split adjusted, it came out at $6,600 per share. Now it's at $15 per share. Has natural gas gone down 99.99% since then? No, it's the cost of rolling the futures. So it's interesting. I look at UNG kind of sometimes day-to-day basis to see, is natural gas up or down on the day or the week? And, kind of gives you a good sense of direction. But that's it. You don't use this as a way to invest in natural gas. If you want to play the upside of natural gas, go buy a company that the vast majority of their production is coming from natural gas. That's the way you play it. You don't buy UNG. Thanks for the call. There's another question that came in via our YouTube channel. Randy23 says, thoughts on CL looks like a good value buy with upside. Good value buy with upside. CL is Colgate-Palmolive, your standard blue chip consumer staple company. Sell toothpaste, toothbrushes, dishwashing liquid, fabric softeners, shampoos, etc. $77 billion market cap. My issue is when you say it's a value play. I don't know where you see that. Okay. It doesn't really look like a cheap stock to me. If you're looking at forward-looking earnings of $3.58 this year, $3.87 next year, and it's a $94 stock. So, a mid-20s multiple, that's not very cheap in my books. Now, they do have a pretty good balance sheet. That's a positive. But if you look over the last 10 years, its enterprise value to EBITDA is average around 18, and that's where it's at now, 18.42. So I wouldn't say it's cheap. I wouldn't say it's expensive. The technicals are okay, but remember, this is one of your typical dividend plays. And if interest rates are going up, their dividend is going to become less attractive. And it's now broken below the 200-day moving average. It's just headed lower on those higher interest rates. So I am passing on Colgate. I don't think it's cheap. I want to wait till you're in an uptrend. Right now it's in a downtrend, and I want it to be cheap, not kind of fairly valued like it is now. Thanks for the call. Now let's talk a little about earnings season. About 75% of companies in the S&P 500 have beat expectations on earnings so far this earnings season. It's pretty much over. Okay, earnings season is pretty much over. That's slightly below the 5-year average of 77%. On the revenue side, 61% of companies beat. The 5-year average is 69%. Okay. Now, that's always interesting, but what's more important is how is the market reacting? Are they punishing companies more? Are they rewarding companies more than average? And the answer there is yes on both, actually. According to FactSet, the average price gain for expectation beaters was 1.5%. 2 days before the earnings release through 2 days after. So a lot of times there's, kind of leaks and bidding up into the report, and then the market adjusting a couple days after. So I like using kind of those 4 days of trading, before, two before, 2 after. The average dip for companies that had negative earnings surprises was 2.9%, both slightly larger than their historical average. So what you're seeing is a bit more market volatility. Now, what about the Mag 7 names? And this is where it gets even more interesting. Why? Because number one, earnings for outside of the Mag 7 is actually growing again. The 493 companies outside the Mag 7 have positive aggregate earnings growth in the last 2 quarters. It had been in decline. And so the rest of the market is delivering growth. It's not the only game in town. Maybe that's why you're having days like today where more money is flowing to those names versus the mega caps, the Mag 7. Now, Microsoft, Apple, and Meta, they beat earnings and revenue expectations, but they still saw their stock fall. And Microsoft and Apple was really because of disappointing forward guidance. Once again, oftentimes it's not just about the beat, but it's about the guidance. And Meta fell because they had declining user growth. And when it comes to capitalizing on AI, really only Google and Amazon have a decent case at it. The rest, Meta, Apple, and Microsoft, are spending a lot of money on it, but they have little revenue to show for it. And so that's one of the issues that's making a lot of those names and attractiveness a lot murkier. Okay, so that's what the current earnings season has looked like so far. Now, what about the proverbial wall of worry? And there are 3 main worries I think the market should be paying attention to, or investors should be paying attention to, that the market might wake up to. Now, number 1 would be the 10-year Treasury rate. It's gone up since basically the start of the market pricing in a Trump victory, and it continues to kind of hold its ground here. Okay, the 10 years now at 4.43% at the close today. If you look at the end of September, it was at 3.6%. I guess that's mid-September. So that's a pretty big move. Nearly 100 basis points in the span of 2 months. With the Fed cutting rates, right? So we know that eventually there's financial gravity here that sets in, that multiples contract if rates go up too much. And higher rates tighten financial conditions, tighten liquidity conditions, and you get some sort of correction, kind of like you saw in 2022. Now, I do think that comes at some point in the next, let's call it 2 years, but it may be from much higher levels from here. It's all going to depend on liquidity. Liquidity remains relatively robust. And so far, as long as liquidity remains abundant, it's hard to get a major correction in markets. Number 2, the credit cycle. What part of the credit cycle are we in? Credit spreads are tight right now. And so the worry is that if credit spreads move up, well, that's a risk-off scenario, and equity markets react accordingly to the downside. But, so far, once again, liquidity is fine, and you aren't really getting a catalyst. Yes, that will be the next move, but it could easily be a year, 2 years from now, and you could have plenty more price appreciation for asset prices between now and then. So far, the credit cycle is not looking ready to turn. Let's say that. Now, going into the end of next year, I think that certainly could be a different dynamic. But for right now, everything is just fine. Now, the last one would be, is AI a bubble? And the simple answer is, yeah, it's a bubble. But once again, I've said this before, it takes liquidity to move the other direction for those valuations broadly to correct like in 2022. So that's the earnings season. That's the current market worries that are there. They're on the horizon, but you don't want to react too soon because, like I said, there can be plenty more upside until there's some sort of major market inflection. Now let's keep things moving and play another question from the 24/7 voice bank at 888-99-chart.
Hi, Justin and Luke. I wanted to ask you a question. I retired early and I'm now enjoying life abroad in the Philippines with my family. I'm in my 40s and I'm exploring ways to generate passive income. I'm particularly interested in quant investing and wanted to get your take on it. Do you think it's a viable way to create consistent passive income? I understand there's a steep learning curve, but I'm ready to put in the effort. If you have any advice, resources, or key things to watch out for as I begin the journey, I greatly appreciate it. Thanks again for all the great work that you do.
All right. So he's talking about is quant investing. You're basically using numbers and investing completely based on the numbers. Here's the issue, is that quant investing has been around for a long time. The most famous one is the long-term capital management, and that blew up in 1998. And quant investing is just, once again, using numbers and no emotions, no what I call qualitative analysis in order to make your decision. You know, for a good example is right now, qualitative analysis is extremely important. Why is that? Because if you're just using the numbers, you're ignoring this new administration that's going to come in, probably make a lot of changes to the way the economy is run, the way different departments are run, how the way regulations are applied and rolled out. And if you're just looking at the numbers, you're ignoring all of that. And so, you know, can it be a part? It's part of our process, right? Is understanding the numbers. But to us, it's just one piece of the puzzle. And so, and you're also, it's very broad, right? What do you mean by quant investing? It's too broad of a term for me to say yes or no. It depends on the strategy you're applying, as well as, you know, is this the only way you invest? Probably not. You know, it could be part of your strategy, could be, you know, a certain portfolio you're running with a certain algorithm or certain quantitative analysis. That's fine. But to say this is all I'm going to do, it's too reliant on just the numbers, and B, you're not giving me any context here. What algorithm are you talking about? Thanks for the call. Now let's play another question now.
I was calling you about get your opinion on Whirlpool. The symbol is WHR. See what a good entry point is for this stock. Thank you. I'll be listening.
Whirlpool, I don't think I need to tell you what they do. They make household appliances, washers and dryers, refrigerators, dishwashers, etc. 6.3% dividend yield, but the earnings have been coming down. Earnings have gone from $26.59 in 2021 when everyone was at home remodeling their homes, you know, hey, I want to upgrade my kitchen, my bathroom, etc. And that's what they were making. And the margins were big. But earnings have continued to fall since. Those to make $11.97 this year and $11.42 next year. And pre-pandemic, they were making $16 per share. So that was kind of a flash in the pan kind of environment, and things are certainly getting worse overall. And they have a ton of debt on their balance sheet. $7.3 billion in long-term debt on a $6 billion market cap. And I don't think that this dividend yield can be sustained. And Proof is they were increasing it consistently until 2022, and it's been flat ever since. So they see it as well, that this is not a sustainable level of dividend payout. So I would not be buying this. I don't like the trend in earnings, and definitely don't expect that dividend yield to be sustained. Thanks for the call.
Thank you for watching.
If this video was helpful, please give it a thumbs up and subscribe to catch our upcoming videos. All right, let's pivot over to a question that was submitted via our YouTube channel. And Charles says, I'd like your take on FRHRH. It is an ADR for Fairfax Financial Canadian Insurer and holding company guided by Prem Watson, and somewhat like Berkshire Hathaway in nature. It was grown very largest holding at 4.5%. I plan to hold for the long term. Thanks in advance. And a suggestion, a Steve Peasley reprise show sometime would be great. That's not a bad idea. We'll definitely think about putting one of those together. Fairfax Financial Holdings out of Canada, like you said, revenue $30 billion. Good profitability, return on equity about 15%, nice 1% dividend yield. And I like the profitability. They're buying back shares kind of consistently. In 2018, they had 29 million shares outstanding. Now only 22 million shares outstanding. So they're certainly using their robust cash flow to buy back shares. Let me take a look at the chart here and see if I can glean anything. Let's pull back to a 5-year chart. Yeah, I mean, I don't really have any issue with this, to be honest with you. I would continue to hold it. 4.5% of your portfolio. There's nothing wrong with the valuation. There's nothing wrong with the cash flow. Like you said, it's in the insurance business, a boring business, but it's a good business, right? It's in the reinsurance market. So yeah, I would continue to hold Fairfax Financial. Thanks for the call. Now, Leslie, let's talk about the holiday season. And Target just had a pretty weak guidance and earnings, mainly because higher margin items such as home goods and electronics are not selling as well. Consumers are spending less on non-essential items. And industry analysts expect a deal-heavy holiday season going forward. And according to the National Retail Federation and Deloitte, overall holiday shopping is expected to grow at its slowest pace in 6 years. One of the contributing factors, though, only 26 days between Black Friday and Christmas. Last year, there were 31 days. So a lot of this is calendar related because if you look at expected number of shoppers that will shop in-store or online between Thanksgiving Day and Cyber Monday this year, that's going from 82 million last year to 182 million last year to 183.4 million this year. Okay. Now, what's interesting is mobile phones are expected to account for 53% of online shopping from November through December. And online spending growth expected to jump to 8.4% from 4.9% last year. Mobile spending expected to grow 12%. Okay, so most of that growth is coming just what you're going to do on your phone. And that's because younger consumers are continuing to drive a lot of the growth in demand. And so that is the expectations for this holiday season. A lot less time, but more promotional in order to pull forward a lot of that demand. I don't know if you've seen a lot of already Black Friday deals being touted. That's because they're saying they're not waiting. Just because the calendar says Black Friday is on the 29th doesn't mean that they're waiting that long, and they're already getting to those promotions. So that's what you should expect from a lot of these retailers and the trends. And obviously that feeds into profits and margins. And we'll see, low expectations so far, and that will make the potential beats, I think, a lot easier as we head into 2025. Remember, the consumer overall is in good shape. Low unemployment, as well as a balance sheet on average that is in better position than it was in 2019. Now, yes, lower income consumers, middle income consumers, a lot of them are hurting, but that's not where most of the spending is happening, right? Most of the spending is coming from upper middle class to the wealthy, and they are doing well. And anyone that has assets, they're doing fairly well. Now, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, Google Play. And be sure to rate and review on iTunes as well. And remember, we can help you better understand your portfolio dynamics and your financial independence goals and calculating your investor risk number by heading over to investtalk.com and click on the portfolio review button. This is a free and confidential service. Independent thinking, shared success. It's InvestTalk. Good night.